My name's Tina Tran, and I'm one of the financial planners in our Burwood office. Now, this video, we will be talking about investment choice in your superannuation. Do you know where your superannuation is invested? Your superannuation is likely to be one of the largest assets funding your retirement, along with your home. So proactively selecting an investment choice is going to determine how much it will grow for you. It will also provide you comfort knowing that it is aligned with your appetite for risk. So by taking control, you'll have peace of mind that there will be a nest egg for you when you stop working. If you haven't made an investment choice, you will be in the Lifetime 1 strategy, which is the fund's default strategy. This strategy follows a trajectory whereby when you are young, this is under 40 years of age, there is more growth investments, which has more volatility risk as you have time to ride out the volatility. So growth assets give a higher average returns over the long term, despite the ups and downs. After 40, the growth investments starts reducing with more defensive investments at each birthday until age 65. At this point, the volatility risk has reduced to a much lower level. So given this default trajectory, the question is this an appropriate investment path for your situation, which might differ from other people? So what can you do? Seek investment advice from a qualified financial planner to tailor an investment strategy that suits you. How you want your money to grow based on your retirement goals and your appetite for risk. When seeking investment advice, the advisor will provide you with a deeper understanding of the trade-offs between risk and return. If you want your investment to grow faster, you'll have to be prepared to accept higher volatility risk. If you're not willing to accept volatility risk, you'll have to accept lower, steady returns. You will be in control of that situation. The advisor will then recommend a portfolio that is right for you. The level of defensive and growth assets will make up this portfolio. So what are defensive and growth asset classifications? Cash and fixed interest investments are considered defensive assets, which should earn you a small return, but it won't lose value in an economic downturn. Shares and property, on the other hand, are growth assets, which is expected that you'll be able to earn a higher rate of return. However, it does come with increased volatility. Holding these assets for the long term will see your superannuation grow nicely if you stick with the strategy. Based on your appetite for risk, a financial planner will recommend an investment suited to you. Now, this may change over time as your situation changes. It's important that these strategies are maintained even when there are bumps in the share market. Your patience will be tested when the share market drops. However, investing and trying to time the market, this is trying to pick the top or the bottom of a cycle, is fraught with danger. Fear and greed can play on the emotions of people and drive their investment decisions, which can cost them money. Having a good strategy and sticking to it will see your retirement funds grow. As an example, investment herd behavior means that as the share market is going gangbusters, people want to be part of it, so they buy in, which may be close to the top of the share market cycle. This is greed-driven. The share market then reverses, and as this picks up momentum and the media latches onto it, the media is saturated with doom and gloom, and you become fearful and sell, except you're now close to the bottom of the cycle, meaning you have bought in high and sold low, probably losing money. Selling assets in a depressed market means you have less shares or less units working for you in any recovery. Emotions should not drive investment decisions. Here's some statistics for you. In June 1933, the share market went up by 105% in 6 months. In 1974, the UK share market went up by 148% in 5 months. Now, unless you were invested in these share markets at this point in time, you would have missed out. So as the saying goes, it's time in the market, not timing the market. Another example of why you should hold on to your long-term strategy, particularly when you have quality assets through a cycle, is, for example, the performance of Commonwealth Bank shares. Prior to the global financial crisis in 2007, the price of Commonwealth Bank shares were approximately $60. At the bottom of the global financial crisis, they dropped to approximately $30. And then in 2015, they went to $90. So you can see if you became fearful and sold the stock on the way down to the bottom of the cycle, you would have locked in real losses. If you had continued to hold on to the shares, then you would have benefited in the long run with the value growing by 50%. And you would have got some income along the way. The learnings from these examples is to avoid the effects of emotions driving your investment decisions, eroding your superannuation, and taking a long-term view. Abandoning a tailored investment strategy could be costly in the long run. Sticking to the strategy will improve your wealth over the long term. So take control of your future, see a financial planner, and invest in the proportion of defensive and growth assets that suits your requirement, not everyone else's. So how do you get investment advice that you need? We offer 2 advice channels that you can select from. The limited advice, which is simple, looks at your superannuation only. Comprehensive advice, which not only looks at your investments, but takes a look at your whole situation, including your partner, to put you in a better position. So if you'd like to make an appointment for advice, give us a call on 1300 658 778 and make an appointment today.